PwC's annual Global CEO survey is widely quoted as a barometer of how CEOs are feeling about the challenges to their business model. And when it comes to insurance, regulation comes right at the top of their agenda, with 94% seeing over-regulation as a threat.
One of the many items on the international regulatory agenda is the development and testing by the International Association of Insurance Supervisors of a new risk-based international capital standard that will apply to internationally active insurance groups. Let's take a look at what this means for insurers in Asia.
First of all, a bit of background. There are two approaches being considered by the IAIS. The first is a market-adjusted basis, where liabilities are valued using an economic approach that transfers most margins from reserves to capital requirements. This is conceptually similar to other regimes like Solvency II in Europe and C-ROSS in China. The other is known as GAAP Plus and differs by starting with accounting values for the opening balance sheet. Now, the idea here is to avoid capital shocks from a significant transition for insurers that have been historically managing to a different regulatory basis, particularly those in the US. The development of the ICS is moving to a fast timetable, with more field testing over 2016 to 2018 towards implementation from 2019. So Saskia, will this lead to more convergence in Asia?
Well, there's a lot of progress already across Asia, in China, Singapore, Thailand, and a regime that could bring more consistency would certainly be welcomed. But there's skepticism over how easy that will be, and a desire not to overdo it and make things more complex. We are seeing banking capital regulation is moving away from complex internal ratings-based approaches to simpler factor-based approaches. And we may see insurance regulation moving towards that school of thinking. Where we do see the possibility of greater convergence is in common standards for risk management and internal capital management through the ORSA process. We're already seeing significant developments in Asia in this area, and we believe that it's the key to successful capital management across the multitude of regulatory regimes that multinational insurers face. Back to you, Chris. What does it mean for Asian insurers?
There are a few Asia-specific characteristics to take into account when looking at the impact here. For example, less mature markets may not have the market data for a full market-consistent approach. Participating business is very popular in Asia, and a new capital standard will have to deal with the treatment of discretion and the valuation of options and guarantees. And more generally, the credit that can be taken for future margins on profitable business is an issue that will need consensus. In terms of what the numbers tell us, well, it will become easier for analysts and investors to compare Asian insurers if they report under a similar capital standard. But the degree to which local regulators will go beyond the minimum standard is uncertain. Whether the comparability of insurers in Asia will lead to a more open market and more competition will really depend on the further convergence that local regulators are striving for. So finally, what steps can an insurer take now?
The most important thing for IAIGs is to take part in the field tests. This has two benefits. It's an important opportunity to influence what the ICS will finally look like. And secondly, it's a good way of practicing collecting the data, running the models, interpreting the results, and explaining them to senior management. There's also a more strategic side to preparation. Despite the uncertainty around the final rules, it would be useful to start thinking what the standards could mean to the business you're writing now, and whether you may need to modify your products or pricing, or raise additional capital.